Fund manager of the Ignis Argonaut European Income Fund is Olliver Russ. Oliver, since launch just above the median, second quartile, but over 1 year and 3 years languishing around the third or fourth quartile. In performance terms, should that worry an investor in your fund?
Well, the thing to remember this fund is it does sit in the European Alpha category, so there is no European income subsector. So it's a bit like putting ordinary UK income funds into the UK or company sector, so you're not really comparing like with like. Having said all that, of course, people are interested in total return. Up until last year, we were doing quite well in that sector. Last year was a bit of an annus horribilis for the relative performance of the fund, because last year, as you recall, was all about cyclicals. The more compromised your balance sheet, the more you cut your dividend, the more you actually rallied in the second half of the year.
So the so-called dash for trash.
Exactly, dash for trash.
Yeah.
And as I think most people will be aware, this fund tends to focus on those higher quality names that are still paying a dividend, and our primary objective is to maintain income as far as we can.
So in terms of the recent performance, are things getting any better for you in terms of the quality of companies and their dividend payouts?
Definitely. We've seen a bit more discrimination, I think, return to the market this year after the first week, which was very much a continuation of what we'd seen through most of last year. Since then, I think markets have settled down a little bit, made a more realistic assessment of some cyclical companies' prospects, and have seemed to return to value and dividend-paying companies in general.
So how would you describe the current shape of the portfolio?
We're focused very much really on the large caps in Europe right now, which are offering fantastic value. We look at it particularly in terms of their corporate bond yield versus their dividend yield. A number of very large cap corporates offer a much greater dividend yield than they do corporate bond yield. That looks like tremendous value.
Why would that be?
It's because government yields are so artificially low to some degree that if you're a non-financial investment grade company, your spreads are very low over that yield as well. So you're right back to sort of 2005 levels in absolute terms.
Which sectors then are working particularly well for you at the moment?
At the moment, people might remember that we've had a long-standing overweight to insurance pretty much throughout the credit crisis. Our view was always that the insurers did not face the same issues that the banks did, although the share prices reacted as if they did. They weren't short of capital in the same way. By and large, they didn't have to cut dividends in the same way, and there was no state aid for them in Europe. Finally, that seems to have been recognised by the market. Although they did perform quite well in the second half of last year, their performance in the first quarter was so abysmal they hadn't really even caught that up by the end of last year. This year, they're doing much, much better. The reason for that? Dividend increases across the sector, representing how cash generative they are and how confident they are in their outlook.
Despite the Greek crisis?
Well, Greece is quite a small economy within the whole European space, and let's not forget that Eurozone as a whole runs a deficit of about 6%, so that's less than half of the UK and indeed the US. So I don't think this crisis necessarily should spill over into the wider Eurozone.
So you don't think there's the fear of contagion to Spain, Italy, Portugal, for example?
There could be, were the ECB and the EU to do nothing about it. But let's not forget, this is at its heart a political project. For Greece to default would mean an end effectively to the euro and by extension to the EU, and it's clear that's not going to happen.
Traditionally, we've looked to the consumer to get us out of difficulty, certainly in the recent past. Where are you in the retail sector across Europe?
Europe looks quite good from a retail perspective. Our two key holdings are Hennes & Mauritz, H&M, and Inditex, which trades as Zara in the UK, both of which offering quite chunky dividend and growth as well.
How much of a difference is there between Northern Europe, the so-called Nordic countries, and Southern Europe, the Mediterranean area?
There have been some country divergences so far this year, much more so than you normally see. Last year was all about sectors. This year, so far, and it's only been 2 months, has really been about countries. So Spain has done very, very badly, actually. much worse than Greece, curiously, year to date, down about 12% versus Greece down 9% currently. Scandinavia, Switzerland, more defensive areas have done actually quite well, so actually up on the year. So there has been a big country dispersion.
What about at the company level? How confident are management at the moment?
Well, judging by the increases in yields we're seeing across a fair few companies, they are gaining in confidence. So we've seen that in the insurance sector, but you've seen it in other areas as well. Unexpected dividend increases suggest a reasonable level of confidence going forward.
For example?
For example, I think you've seen that in some of the retailers as well. I think you'll see it in quite a broad range of the market as we move through results season. We're about halfway through results season right now.
Some concerns about inflation, obviously from the minimal interest rates that we've seen. What's your view and how would it affect the fund?
In aggregate, in Eurozone, inflation is just not a problem. It's very, very low. In fact, we'd probably be more worried about deflation than inflation, precisely because of the strong currency we've seen over the last couple of years. So it's really not an issue for the ECB right now. They're not really looking to raise rates based on an inflationary outlook. Very different situation in the UK, where you can see core inflation rise very markedly. We're now in letter writing territory to the Chancellor, and it's difficult to see how that inflationary impetus is going to abate with a weak currency.
How much influence does what's going on in China and the United States of America actually affect you and the fund?
China, not so much. We tend to be geared more to the domestic plays in this particular fund, but the European markets as a whole react very significantly to what's going on in the US. So Europe is much more sensitive to US earnings numbers and economic releases than its own for some curious reason.
Let's turn to currency then. What's your view on currency and what effect it's having on you?
Well, we try not to have too much of a view on euro sterling, which is a key currency rate, of course, for investors in this fund. The view at the start of the year, of course, was that sterling would be quite strong relative to euro, which turned out to be the case for a month or so, but just recently that's completely reversed. And now, despite all the Greek headlines, despite all the headlines you read in the papers about the euro collapsing or maybe breaking up, actually it's strengthened year to date versus sterling. So currency market's very, very difficult to call this year. For sterling, a lot is going to depend on the election. As we move closer to election date, sterling will move in line with the polls, I suspect.
And from an investor's point of view, the fluctuations in currency, how much does that affect the way that your companies run their business?
Not too much. They generally in the Eurozone have got used to operating with a strong currency. So they haven't had to devalue their way out of trouble, so they haven't boosted exports in that way. If the euro does weaken, particularly against dollar or yen, which are their key export competitors, then that actually becomes a bit of a tailwind for European companies, because it does free up some of the export pressure that they've been under recently.
Okay, let's turn to an outlook now for European income in general.
Well, this year we should see a growing dividend over last year, where we had to cut the dividend slightly in line with the market. We now look to see a return to dividend growth this year by about 10% in the wider market. I think we will do slightly better than that on the fund. And in terms of valuations, we're looking at 25% earnings growth this year and next year, according to consensus numbers. If that comes through, we don't see a double-dip recession, then 2011 the market's on about 10 times earnings, which looks pretty cheap. On a yield basis, we're about 3.5, 3.7 at a market level, which again doesn't look too bad value relative to history.
And on the fund itself, around a 6% yield?
Historically that's the case. The forward-looking yield, which we prefer to quote, because it's more accurate representation of what people will receive if they invest today, we're looking at about 4.5%.
Okay, and still with that all-important preservation of capital in mind?
Yeah, we don't want to take unnecessary risks because, again, this year will be very, very challenging. We don't know what unforeseen events may yet occur.
Olliver Russ, thank you very much indeed.
Thank you.